on Wealth Track, two top global strategists, Fort Washington Advisors Nick Sargent and New York Life's John Kim, discuss markets at a crossroad. Which direction should investors take as world economies slow, government stimulus wanes, and global risks increase? Nick Sargent and John Kim are next on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together we help provide a lifetime of guaranteed income and investment solutions.
Additional funding provided by Loomis Sales. Investors seeking exceptional opportunities globally. Research affiliates. An efficient index for an inefficient market. Wintergreen, your home for global value. And Rosalind P. Walter.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Fair is foul and foul is fair, say the witches in Macbeth. For all of the fair benefits of globalization, it is the foul perils that are being felt in the markets right now. The dichotomy of Eurozone interdependency, one currency but many government policies, is turning out to be an ongoing curse for the 27-nation union, their banks, and global markets. This week, the fears of debt difficulties and default spread from Greece to Italy, Europe's third largest economy, to Spain, its fourth biggest, as well as the other heavily indebted countries known as the Pigs, including Portugal and Ireland. At one point, for the first time since the euro was created in 1999, interest rates on 10-year Spanish and Italian bonds climbed above 6%. To put that into context, yields on 10-year bonds in Germany, considered to be the strongman of Europe, are yielding under 3%. As this chart from Strategas Research shows, the difference in yields or spreads between other European government bonds and German bonds has widened dramatically. Strategas' conclusion: anything that isn't U.S., German, or perhaps Japanese sovereign debt is likely to come under increased pressure. Well, meanwhile, the U.S. is under increasing pressure to resolve its debt ceiling impasse. Ratings agencies S&P and Moody's say they are reviewing the government's AAA rating in light of the rising possibility that the $14.29 trillion borrowing limit won't be raised in time for the government to pay its bills. However, investors don't seem alarmed. Once again, they sought the safety of U.S. Treasury bonds. Contrary to just about every Wall Street prognosticator, Treasuries have appreciated this year, once again giving stocks a run for their money. U.S. stocks, meanwhile, have had their share of volatility in recent weeks, but are still in positive territory for the year. What's the outlook from here? We are joined by two highly respected investment pros. John Kim is Chief Investment Officer of New York Life, where he oversees more than $330 billion in assets. New York Life is a sponsor of Wealth Track, but John is here on his own merits. He has a 26-year track record of running investment management and retirement businesses at major insurance firms. Nick Sargent is Chief Investment Officer of Fort Washington Investment Advisors, the investment arm of another insurance firm, Western and Southern. Nick is a longtime international economist and global money manager with experience at several top Wall Street firms, as well as the Federal Reserve and U.S. Treasury. I began the interview by asking Nick why he believes the markets are at a crossroads.
For 2 years now, we've had the strongest rally in the stock market, off the lows, so you doubled in value. But it was broader than the stock market. Almost all so-called risk assets, corporate bonds, high-yield bonds, also did extremely well. So in the last couple of months, though, we've had markets now much more choppy. And why? That's what I say. I think we're at an inflection point, and there's so many things we have to consider today. Question I have. The economy, it disappointed in the first half. Will it come back, as some people say, in the second half or not? Inflation. Some people focus on food and energy and say it's going up, but the core rate has remained tame. So which one will be the accurate gauge? Policy. The Federal Reserve is completed its quantitative easing program, and what will that do? And now, of course, on the budget, we've gone from massive stimulus to some restraint. We don't know how much. And then developments abroad. You have Middle East oil prices up, Japan, the tsunami, the nuclear, and then Europe, the problems again resurfacing. So all of these factors you have to weigh, and many are offsetting.
All right, there we are. So the markets have to kind of digest all of these factors. So the question is, so how do you think the markets are going to digest them? I mean, what's your outlook for the second half?
That's right. I begin with the economy because I think that was the big disappointment. And many people were getting encouraged that finally maybe we got escape velocity, the term Larry Summers uses, that maybe growth would have been strong enough that we start to create enough jobs so you can back away from the stimulus programs. And then instead the growth rate came in the first half of the year 2%, half of what was forecast. So I believe that there are some reasons for that things will be better. Oil prices have come off their peak, and that will put more money into people's pocketbooks. We basically have also the situation where the supply disruptions in Japan are waning. Auto production is being boosted. The but, though, is it is this policy situation that the Fed is not going to do a third quantitative easing program immediately. And then, for the first time, I'm glad fiscal restraint is coming, but it will be a drag. So my call is that the economy will do somewhat better, but we're not going to meet the expectations at the beginning of the year.
All right, so somewhat better than the first half.
Yes.
So John Kim, markets at a crossroad, when you think of all of the things that Nick has just mentioned that we're dealing with, what do you think the impact is going to be in the economy?
We don't focus a lot on the short term, but as Nick suggested, I believe that the economy will be stronger in the second half. Perhaps 3.5% in the third and fourth quarter
for GDP.
For GDP growth rate. Clearly, the monetary and fiscal stimulus, at least in the near term, will continue. And so investors will generally have this risk-on posture. And as a result, I believe that equities and spread products in the credit markets will do generally fairly well.
So high-yield bonds, for instance, what about commodities? I mean, so all of the risk-on trades that you're talking about, so the stocks and then the things that people who are more aggressive investors that they
Yes.
tend to, you think that those are going to continue to do well
I do,
in the
but
second half?
I do. However, I would say that commodities tend to be one part investments and another part related to the fundamentals of how the global economies are doing. I do think commodity prices, starting with oil, will remain fairly benign here for the foreseeable future, which really is the reason why the economy should do well, because they have come off of their highs. So it's going to help the economic growth here, not only in the U.S. but worldwide. Clearly, high-yield bonds, I believe, will do well. If you look at it on a spread over treasuries basis, high-yield bonds are trading at their historical averages, and the default environment is so non-existent today that just clipping coupon in the high-yield sector will provide you with a pretty handsome total rate of return.
So longer term, and I know this is what WealthTrack focuses on, as do you two, because your respective insurance companies have got to meet those long-term liabilities. So longer term, John, you have some pretty serious concerns, right? So looking to 2012 and beyond.
No question. Longer term, there are so many downside risks that I see versus upside potential, and that's the cause of grave concern to us. So if you start with the U.S., then we could spend hours and talk about the rest of the world, but just in the U.S., we've got a chronic high unemployment situation, which I don't believe we're going to reduce our unemployment rate nor our underemployment rate to a meaningful degree in the foreseeable future. The housing sector is the worst it's ever been. And this is not, in my mind, an area that's going to recover very, very quickly. And then last but not least, we talk about the debt load of the federal government, but the consumer debt load is still near record high. So you add $14.5 trillion of the federal debt, and then you add $2.4 trillion of consumer debt in the aggregate. And those are numbers that are not going to get pared down quickly in the near term.
So before I hide under a rock,
Right.
essentially, I'll ask you about the investment implications in a minute.
Sure.
But Nick, so as far as the long-term
Yes.
burdens that you see, I mean, and versus maybe the long-term drivers of growth,
Yes.
how do you come out?
I
on
agree
that scenario
with
as well?
a number of the points that John was making, especially I think that the unemployment rate just isn't responding as quickly as it did before, and I think it's a different cycle. It's a debt cycle. It isn't an inflation cycle where once the Fed eases, jobs could come back quickly. But maybe just as the counterbalance is that why is it then that I'm not overly bearish? And I think that when we go and ask the question, why did the stock market double if the economy isn't doing all that well? I always tell people, I say, remember, the stock market is the barometer of the corporate sector. And so what's been amazing is that we've basically seen corporate profits that had gotten hammered in the financial crisis rebound and are now above their pre-crisis levels. And then again, when we go and look at just equity market valuations, PE multiples, or however you choose to do it, they don't look at extremes. They're not cheap. So my feeling is that we're probably in a continued pattern of a subpar expansion, but it is an expansion. I think inflation is not going to rear out of control, and therefore rates stay lower longer. And the corporate sector is the bright spot in otherwise sectors that are in trouble, such as housing that he mentioned.
So John, tell me about how New York Life is changing its risk management approach.
Sure.
And also then let's talk about some of the longer term scenarios that you're working on and tell us about the investment implications.
Right. I might qualify that statement. It's rather than changing, we're sort of clarifying the way we look at risk. What we have done, we've actually been forced to do this, Consuela, is that because of our inability to accurately predict the probability of something occurring, we've actually looked at various events and not tried to spend as much effort and resources on trying to determine the probability of it, but more importantly, what's the path of those events if they were to occur? And we try to identify some leading indicators of things that we should be focused in on, and at the point that those indicators are triggered, then we'll pay greater attention to perhaps the probability of that particular event occurring. So give us an example of a working scenario that you're Sure.
looking at and how you're analyzing it.
Absolutely. So the Euro crisis and how the Greek situation and now the Portuguese situation is evolving is capturing a lot of sort of attention and discussions and the like. Who knows, what the ultimate sort of restructuring of the Greek bailout plan is going to be. In many respects, I feel like today we're just kicking the can down the road here, and we have the inevitable of a restructuring of the entire debt structure of not only Greece, but all of the PIGS economies here. So rather than try to determine what the probability and the makeup of a Greek restructuring might look like, we might wish to focus in on another indicator to give us some insights as to when the inevitable is going to occur. And in the Euro situation, ultimately we're less concerned about Greece, but more concerned about Spain, because Spain, as opposed to Greece is about 2% of the European Union economy. Spain is 12%. And so we think that just calibrating where the Spanish debt rate is, it might be a better indication of how the European situation is ultimately going to resolve itself. So that by way of example.
All right. And so what is it telling you?
It's telling us that the 10-year Spanish government bond last November was at 4%. Today it's around 5.5%, which clearly suggests that Spain is not in the news prominently, but there is some now concerns that this sort of Greek and Portuguese contagion effect might now impact the rest of continental Europe. And so we would suggest that if the Spanish government bond rises from 5.5 to perhaps 7.5, 8%, that would be a cause for alarm.
So Nick, how alarmed are you about what's going on in the Eurozone, and how are you reacting to it?
So really, I think what caught my attention in the last month was that when I realized that there were the protests in Greece, and the Greek government nearly fell.
Right.
Suddenly, what this told you is, wait a minute, is it the creditors who are calling the shots, or is it the debtor countries? So what I simply did in the sense of urgency is said, okay, I don't have the luxury of saying I'll worry about this 2 years from now. So we called together our little war room and discussed, how we thought things would play out. One of the big fears was, is this another Lehman situation or not? Our conclusion was no, that unlike subprime, where it was surprise, 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 you didn't know this. Who doesn't know what Greece's debt is and who holds that debt? Same for. So there's much greater transparency, and therefore I think less risk of the contagion. But it's funny, as John mentioned, what would be a game changer? And we didn't even talk about this, but my story has been, if you get Spain into the equation, that becomes a game changer. Why? Because the size of the economy and the linkages in the international financial system. And if Spain goes next up on the on-deck circle is Italy.
When do you start, number one, reacting as investors? And if, in fact, you start to see the Spanish bonds moving up, what do you do as a result?
Right. Well, two things. One is that if you have any exposure to the European markets, then you might want to consider paring back that exposure. But
and you're talking about the equity markets and the bond markets,
and
right?
the fixed income markets, exactly. So if you're in a European equity fund, for example, and you see the 10-year Spanish government bond rising, that might be a good leading indicator that there might be more systemic issues for continental Europe. The second, though, and this is really, Nick mentioned the comment about a contagion effect here. I believe there's a very small probability, but it's not zero, that a collapse of the Eurozone in some form or fashion, led not by Greece or Portugal, but by Spain and Italy, might have a contagion effect for the rest of the world economies here. So the first order would be, look at your portfolio in the context of your exposure directly to Europe. But then the second would be, if there is some fear and expectation that this could have a contagion-like effect for the rest of the global markets, then you might want to take some risk off the table for the rest of your portfolio.
So let me ask you about other game changers. And Nick, you just got back from China,
Yes.
and there is a consensus, I think probably it's a global consensus, that China is the emerging world power. It's going to be the driver of global growth. It's going to pick up the slack of the U.S. So what's your assessment of China and that scenario playing out?
It's clear. It has been the leading engine for over a decade now. And I would say it's a game changer. So if something went wrong in China, where it would first show up would be other emerging Asian economies that have really benefited, plus other emerging economies, including Brazil and the like, that are resource-based, shipping into China. So, when I went there, I guess I was a bit surprised. The people I spoke to, unlike the United States, there's tremendous confidence, and I guess understandably so. They've grown at double digits. They got through the financial crisis with not much disruption. But I would say, Consuelo, still, the reports beneath the surface are a bit more troubling. We all know about the housing boom, their property boom. But more and more, the stories that we're hearing is that the government encouraged during the weak period after the financial crisis local governments and banks to make tremendous amounts of investment. Now, you always say, well, how can investment be bad? But in China today, investments are 50% of the economy. And I don't know any economy that can sustain that high level without problems, and we're starting to see them surfacing. So the real question then in my mind is, okay, let's assume that there's a hiccup somewhere along the line. How bad will it be? I've come away, rightly or wrongly, with the conclusion I don't think it will be an Asian-style financial crisis, because China has $3 trillion of foreign exchange reserves and they have capital controls. It's not money coming in, money going out. But at the end of the day, what it will be is that the Chinese government basically underwriting the problem loans, and there won't be congressional hearings about whether the electorate thinks it's a good idea.
They can just do it.
They will do it. So you could say, well, that's not so bad. However, the question then is, though, in order to underwrite these bad loans, could you see their growth trajectory slow below 8%? For China, that would be a big deal because they need that much growth to continue the migration from the rural areas into the cities. So that's the type of issue that you're tracking. I guess my
So below 8% is like a recession in China?
Let's call it a growth recession.
Right.
Yeah.
One of your major investment concerns, John, is the fact that you're concerned about it here at home is a possibility of stagflation.
Yes.
And so tell us about why you think that is a risk, and especially for investors.
Sure. So when we talk about possibilities, again, I think it's a remote possibility, a low probability. But we are always concerned about these outlier risks out there. So one can very easily cobble together a scenario where the U.S. economy remains fairly stagnant, not fall into a recession, but a flattish type of an economic growth, very similar to, again, what Nick mentioned a few minutes ago. Then you've got the exogenous factors that will cause inflation that will come into our system that's utterly out of our control.
So Nick, what is a major investment theme that you're following at Fort Washington?
The idea is pretty simple, is that some of the bigger companies, the bigger blue chip names, have really probably underperformed. So from a valuation perspective, look attractive to us. And if we can get dividend yields that are close to what we can get on corporate bonds, why not?
So John Kim, major investment themes
Sure.
for you at New York Life?
And that would be basically go international. Don't go all into emerging markets or developing markets. So go into a nice, high-quality international fund that invests both in developed and developing markets. And importantly, the core of that investment strategy should not have any overt currency hedging. So let the investment sort of ride the natural local currency exposure that would be coming from the collection of the stocks and bonds that would be in the portfolio.
So it would be a diversified international fund, but with
Correct.
both stocks and bonds.
That's right.
Right,
So
unhedged.
taking advantage of opportunities, the outsized opportunities outside the U.S., and having non-dollar exposure.
So Nick, one investment for a long-term diversified portfolio, what should we all consider owning some of?
I agree that the housing market is not about to turn quickly, but I still believe that investors looking for a long-term investment, that if you ask this question, which market today is most mispriced? We said it wasn't the stock market or necessarily the bond market, but I have a housing market where, on average, home prices are off 35% from the peak or more. Some locales even more than that. But then add to that where mortgage rates are almost as low as I can remember in my lifetime, and I'm not a young guy. So you combine the interest rate on your mortgage with the cheaper home price, and housing affordability is now the cheapest in 4 decades. But today I hear people tell me home prices will never go up. That to me is, again, the overreaction. So have fun. Go out and buy a home today.
Good advice, especially for younger people who are avoiding buying homes now
Yes.
and are becoming renters, and rent prices are going up.
Exactly.
So thank you so much, both
Thank
of you, for
Thank
such
you,
a
Sue.
terrific conversation and some great investment ideas as well. Nick Sargent from Fort Washington Investment Advisors and John Kim from New York Life. Thanks for joining us on Wealth Track.
Thank you.
Who would have thought that buying a home would ever be considered a contrarian investment idea? And on that note, we will wrap up this edition of Wealth Track. Next week, we are sitting down with one of our great investors, Dennis Statman, who has run BlackRock's now $55 billion global allocation fund since its 1989 inception, will join us to talk about the opportunities he is still finding around the world. In the meantime, to watch this program again, please go to our website, wealthtrack.com, to see it as a podcast or streaming video. And while you're there, check out Wealth Track Extra, where you can find complete extended interviews with other recent financial thought leaders and great investor guests. Thank you for visiting with us, and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales. Investors seeking exceptional opportunities globally. Research affiliates. An efficient index for an inefficient market. Wintergreen, your home for global value. And Rosalind P. Walter.